Good morning and welcome to our Winter 2020 Financial Reporting Seminar. We'd rather be doing this in person, having given you a sausage sandwich and a nice cup of coffee. We've done quite a few online seminars recently, which has worked well, so we hope this one does too, and that you've supplied yourselves with appropriate refreshments. A couple of housekeeping points before we start. If you could just make sure that you're all on mute throughout the presentation. If you have any questions, please put them in the chat function and we'll pick them up at the end. For those of you that don't know me, I'm Craig Burton. I'm a commercial partner at Hawson. I act for clients in a broad range of sectors with a focus on manufacturing, architects and consulting engineers. Most of my clients have audits, but I do act for clients that are below the audit threshold as well. I also act as the technical partner at Hawson's, responsible for maintaining technical standards throughout the firm. Paul, would you like to introduce yourself?
Yeah, sure. Good morning, everybody. I'm Paul Hutchings. I'm one of the audit managers here at Sheffield office, and I look after a wide portfolio of corporate clients, predominantly owner-managed businesses and SMEs. I also have the role of technical director at the firm, working closely with Craig to help our partners, staff and our clients to keep up to date with the latest auditing and financial reporting developments.
Thanks, Paul. This presentation is headlined Current Issues in Financial Reporting for SMEs. So we're going to presume that you're all following FRS 102 and FRS 102 Section 1A, not International Financial Reporting Standards. At the advent of FRS 102, the FRC said that they didn't want to make regular piecemeal changes to the standard, and that they would save all the changes up and make a number of changes every 3 years, which they named the triennial review. The last triennial review was published in December 2017, effective for periods commencing on or after the 1st of January 2019, and the next one hasn't yet been published. So there's not many accounting standard changes to talk about this morning. Having said that, in response to COVID-19, the FRC have published an amendment to FRS 102 this year, relating to rent concessions, which I'll cover later. I'll also look at the application of FRS 102 to the various different loans and grants that have been available to businesses this year. Before that, I'll look at something that's become an even bigger issue for us auditors this year, going concern. Once I've covered the COVID-19 related matters, Paul will pick up Brexit, which did seem to fade from our minds for a few weeks during the start of the pandemic, but certainly is starting to loom large now, particularly with Boris's dinner in Brussels last night. Paul will finish up with a reminder of the 2017 triennial review, as well as looking into his crystal ball for items that might be included on the next one. As I said, please use the chat function to note any questions as we go through, and Paul and I will answer questions at the end. So following the well-publicised corporate failures of recent years, BHS, Carillion, Thomas Cook to name but a few, going concern has been a topic high on the profession's agenda for directors, accountants and auditors alike. In response, at the end of last year, the FRC published a new auditing standard on going concern, which comes into effect for December 19, which means that your auditors will have to do more work to get comfortable around what the directors have done to ensure that your company is a going concern. Then the pandemic hit with all the uncertainty that that brought and raised questions about what the going concern assumption means in the times of a global pandemic. Very usefully, back in May 2020, so at the height of the pandemic lockdown, the ICAW, together with the Institute of Chartered Accountants in Scotland, issued guidance for directors on their responsibilities for going concern. The guide reminds us that all accounts, including statutory accounts, measure past events, but that they are prepared on a going concern basis, i.e. assets and liabilities are measured and classified on the assumption that the entity can continue to trade for the foreseeable future. The most obvious example is a piece of equipment that's been purchased, measured at cost and included on the balance sheet as an asset, as the entity will generate future benefits from that asset. In a company, it's the director's responsibility to assess going concern. When they're preparing the accounts on a going concern basis, they need to assure that that basis is appropriate. Your accountant or auditor is likely to ask for evidence you have done this, particularly if you're subject to audit, given the new auditing standard on going concern. So what evidence can you show your auditors that you have considered the going concern assumption? Ideally, you'll have some cash flow forecasts which cover the foreseeable future. And for both directors and auditors, this needs to cover a period of at least 12 months from the date of approval of the financial statements. In normal times, companies have 9 months to file their accounts at Companies House. That's currently extended to 12 months. So the period that needs to be covered by the cash flow forecast could be significantly more than just the next year's budget. If we consider a December 19 year-end companies whose accounts are signed off in September 2020, their 2020 budgets will only cover a period of 3 months from approval of the accounts, definitely shorter than the foreseeable future defined as 12 months. Those cash flow forecasts prepared should be used to identify any cash shortfalls in the period, or even just points where the headroom becomes tight, and the directors need to plan actions to prevent or mitigate those shortfalls, and show those plans to the auditors. And cash flow forecasts are much better than evidence than profit and loss budgets. As we all know, cash is king and profitable companies can run out of cash. Preparing forecasts is looking into the future, so everyone recognizes that it's not a precise science. Directors need to make assumptions, apply them consistently, and be able to defend those assumptions. Directors should test the forecast for different assumptions, downside and upside, or think about developing a range of expectations, so a worst case, a base case, and a good case, to help identify the need for business critical decisions. A term that has been spoken a lot recently is the reverse stress test. This means identifying the assumptions that would result in the company running out of cash, and hopefully being able to show that the likelihood of those assumptions actually happening is remote, or that the directors can take appropriate mitigating action to prevent the company running out of cash. When developing a forecast, a cautious approach is best. You don't want to base your forecasts on unrealistically high expectations, for example, over sales. Other items to consider when preparing your financial statements during this pandemic. Your accounts do need to give a true and fair view. And to do that, you probably need to disclose the impact of COVID-19 on your business and the impact on the numbers in the accounts. If you're not a small company, you need to do this in your strategic report. And for all companies, you need to question whether you need some disclosure in the notes to your accounts as well. You also need to think about the valuation of the assets. Has COVID resulted in any impairment of your stock, debtors, or fixed assets? As with most things, clear disclosure of the impact of COVID should result in a clean audit report. When we went into the pandemic, the thought in the profession was that material uncertainty paragraphs around going concern would become more common. Although the experience that we've had is that the support from the government has given businesses the resources to see their way through the pandemic, at least up till now. And so actually we have seen fewer material uncertainties than I may have expected back in March and April. So I said in my introduction that the FRC weren't going to make any changes to FRS 102 apart from in the triennial reviews. But this year, due to the exceptional circumstances that we found ourselves in, the FRC have made an amendment to FRS 102 in respect of rent concessions. So it was initially published as FRED 76 and was brought into an amendment to FRS 102 in October. The amendment applies only to rent concessions given by landlords as a direct consequence of COVID-19, of which I'm sure there are many. Normally, rent concessions, usually rent-free periods at the beginning of a lease, are spread over the life of the lease. So without this amendment, the treatment under FRS 102 would be the same, i.e. to spread the concession over the remaining life of the lease. But this amendment says that you don't do that. These concessions were specifically to help businesses out during the pandemic period, so should be recognised in the P&L in the period that the concession is intended to compensate. So effectively, you recognise the reduction in rent charge as it happens. There are certain conditions required to apply this treatment. The change has to be a reduction in rent. It only applies to payments which were due on or before the 30th of June 2021. And there has to be no other change to the terms of the lease. Otherwise, the rent concessions could be due to those changes rather than just to COVID-19. And you need to disclose the change in lease payments in your accounts. The effective date of this amendment is periods commencing on or after the 1st of January 2020, but early application is permitted. So you could apply to the years ending on or after the 31st of March 2020, as long as those accounts weren't signed off before the amendments were issued. The slide says expected in 2020, that actually happened in October 2020, actually on the 7th of October 2020. So any account signed after the 7th of October can apply the amendment for periods after the 31st of March 2020. The support for businesses from the government has resulted in many companies receiving COVID-specific loans and grants. So we thought it would be useful to look at how FRS 102 applies to those different loans and grants. FRS 102 allows an accounting policy choice for government grants, the accrual model or the performance model. The COVID-19 grants are revenue-based grants, so the accountant treatment is the same, irrespective of the model that you apply. So if we consider some of those grants in turn, for the CJRS or furlough grants, you recognise the grant in the P&L as income. You don't offset it against the wages and salary costs. So you recognise it as other operating income as a separate line on the P&L. And you recognise a debtor for any grants that you have applied for but not yet received. The statutory sick pay rebate is also treated as a government grant. You recognise in the profit and loss account as the income becomes receivable. Again, you don't offset it against the payroll cost, and you recognise a debtor for any rebate receivable but not yet received. The business rates relief isn't actually a grant. It's just recognised as a reduction in the rates charge for the period that you get the relief. And therefore, all you do is you reduce the rates charge in your profit and loss account for the period that you get the relief. The other grants that have been available, such as the Small Business Grant Fund and the Retail, Hospitality and Leisure Grant Fund and the Discretionary Fund and the Cultural Recovery Fund, for example, you recognise those immediately in the P&L as income as they're received or as they become receivable. If we then think about the different loans, first of all, think about the CBILS loans. And if we think about the fees and charges that are applied, the government makes a business interruption payment to the lender covering the first 12 months of interest and charges. As we know, the borrower is still 100% liable for the debt. And because of this, interest should be recognised as a charge in the profit and loss account, even though the borrower isn't paying that interest. So therefore, the business interruption payment should be recognised as income in the profit and loss account and not set off against the interest. One thing to consider here, though, is materiality. If the interest charge isn't material with the low interest rates that we currently have, then I'm not sure actually finding out what that interest is and recognising it separately on the P&L account is necessary. But you do have to consider whether it's material. If we consider bounce back loans, these are loans available to smaller businesses, no fees or charges up front. The loans are up to £50,000. And again, the government guarantees 100% of the loan. Again, the government makes a business interruption payment to the lender covering the first year's interest, and the interest is capped at 2.5% per year. Similarly to the Sybil's loans, the interest charge should be recognised in the profit and loss account, and the business interruption payment treated as a government grant recognised in the profit and loss account as income, not set off against the interest. But again, we need to consider materiality and whether that interest is material and whether we need to split it out. And with that, I'll hand over to Paul to take us through the impact of Brexit on financial reporting.
Thanks, Craig. So we left the EU earlier this year, and then we entered the transition period. And then coronavirus came to the UK and diverted our collective attention away from Brexit. Since then, companies have had to grapple with both the immediate impact of the pandemic on their business and also how to prepare for the end of the transition period on the 31st of December. This week, we see the UK and Brussels still trying to arrive at some kind of trade deal post 31st of December. And so even now, at the 11th hour, there's still great uncertainty over how the post-Brexit landscape will look for businesses as we go into 2021. Now, this means that there are aspects of financial reporting that are likely to require more attention as our new relationship with the EU, in whatever form that takes, begins next year. So this section of the presentation, we're looking to highlight a few of the more significant issues that we think need to be considered as we prepare financial statements over the coming months and as the exact form of our new relationship with the EU becomes clearer. Next slide, please. So the first issue is impairment of assets. Depending on the shape of any deal that is reached, Brexit may affect the recoverable amounts of assets, possibly leading to the need for impairment provisions in the accounts. So we need to be alert to impairment indicators specifically resulting from Brexit. Stock and inventories are reviewed for impairment on an annual basis, and so there we'll have to consider whether the terms under which we are leaving the EU create an adverse legal landscape which could affect our ability to sell stocks into our usual markets or could significantly increase the costs of doing so. There could also be other issues. For example, a decrease in the availability of labour supplied by EU workers could push employment costs up. So there could be factors that either bring the net realisable value of stock down or push the cost up, which either way may lead to provisions being needed against stock where previously there were no issues. Where we have other assets, such as property, plant and equipment, we review those whenever there are any indications that recoverable amounts are below the carrying amounts in the accounts. So when considering the impairment of these types of assets, we should remember that recoverable amount of an asset could be its value in use to the business, if that is higher than the market price it could achieve if sold. So therefore, even if commercial property values are adversely affected in any post-Brexit slump, if the property is still fully utilised in the business rather than surplus to requirements, the carrying value in the accounts may not be affected. However, we should still review the useful life of the asset, as that could be affected, and that would have a follow-on impact on the depreciation charged through the P&L. And one final point on assets, where the post-Brexit landscape creates any uncertainty, if we need property valuations for the accounts, you should consider using professional valuers rather than relying on direct valuations. Because even though professional valuations are not mandatory under FRS 102, in such a climate, it's probable that directors will struggle to make reliable valuations, and auditors will probably expect professionals to be involved in the valuation process. New slide, please. So next, provisions. With provisions, you need to be aware of over-providing based on Brexit uncertainty. Costs anticipated and associated directly with Brexit should only be provided if there's a legal or constructive obligation to incur those costs as at the balance sheet date. So for instance, if a company is pushed into restructuring, a constructive obligation to make a provision only exists at the balance sheet date if those plans to restructure have been formulated by the year end and formal announcements have been made to those affected by the plans. Just having an intention to restructure at some point in the future isn't sufficient grounds to recognise provision at the year end. Where there's a high degree of uncertainty caused by the new business landscape, it's likely that directors will more than ever be required to make judgments and estimates that significantly affect the accounts. They should therefore be prepared to disclose those judgments and estimates in the accounts, and disclosure should focus on the specific amounts in the accounts that are at risk of material adjustment in the next year, should those judgments and estimates change. Next slide, please. To capture all the material impacts of our departure from the EU, you should plan to undertake a comprehensive post-balance sheet event review. Now, where such a review identifies relevant information, we need to assess whether the information provides evidence in relation to circumstances that existed at the balance sheet date, which would mean it was an adjusting post-balance sheet event, which required adjustments to the accounts, or whether it relates instead to circumstances which arose after the balance sheet date, which, although these may ultimately impact the amounts recognised in the accounts, they would be a non-adjusting event at the balance sheet date, simply requiring disclosure in the accounts with amounts left unadjusted. Now, with the transition period ending on the 31st of December and the new relationship with the EU beginning on the 1st of January, this could present challenges for December 2020 year ends in particular, as it may be difficult to establish whether an event after the year end, in Q1 2021 say, related to conditions existing at the balance sheet date or not. We can see scope for different interpretations being applied, so just be prepared to back up any judgment calls with your auditors. Next slide, please. Should we get to the end of the transition period, and as is looking likely, there be no deal or a poor deal, the resulting complexities for businesses are likely to require more detailed disclosures in the accounts, even for small companies that apply Section 1A of FRS 102. This is because of the overall true and fair requirement, which requires directors to make disclosure over and above those that are mandatory if such disclosure is necessary for the accounts to show a true and fair view. This is where a strategic report or a director's report could be useful to provide context to a reader of the accounts, and also to give an insight into the company's future post-Brexit and its ability to deal with the anticipated challenges and uncertainties. Now, small companies are not required to file a director's report with the accounts, but they can always choose to do so if they think it'd be helpful for outside users of the accounts to better understand the position that the business is in. Next slide, please. Finally, we have the issue of business continuity. Many businesses may find the switch to a new relationship with the EU is relatively seamless if they have limited trade with suppliers or customers on the continent. However, for many more, this will be a challenging time for them. Sales contracts could become less profitable due to customs duties, tariffs, delays at ports, unfavourable exchange movements. In worst case, contracts could become onerous unless the business is able to renegotiate terms. All these factors need to be considered when thinking about the company's ability to continue in business. And as we said earlier, as Craig said earlier, appropriate disclosure will need to be made in the accounts. Where the business will be heavily dependent on the support of shareholders or third-party funders for its continued existence, then confirmation of that support being forthcoming in a landscape of higher commercial risk should be obtained. Next slide, please. So, lots to think about there. We'll now move on to look at the ways in which a parent company can be exempt from preparing group accounts and how Brexit could impact those. Next slide, please. We'll start off with a quick recap of the exemptions. Firstly, there's the exemption for a parent company that is itself small and heads up a small group. There then go on to be further possible exemptions for intermediate parent companies that don't meet the small group requirement. So taking the first of those exemptions, what do we mean by a small group? Well, the thresholds are there on the slide. We've got three benchmarks: turnover, balance sheet total, and employees. And we've got net thresholds and we've got gross thresholds. The gross thresholds are what you look at first. You simply take the parent and the subsidiaries, add the figures together, and see if you breach the gross threshold. If you do breach it, then you maybe look at, so the gross thresholds are without taking into account consolidation adjustments. If you breach those gross thresholds, then you can look at your consolidation adjustments, take those out, and see if you fall within the net basis. And to qualify as a small group, you have to satisfy 2 of the 3, net or gross, or a mix. Next slide, please. So just to point out that with those gross thresholds, there is the possibility for a group containing a medium-sized company to still be a small group, but critically the parent company must itself be small. Next slide, please. So we know what small means, and we tick that box, but there are still eligibility requirements that we could fall foul of. So we need to make sure that our small parent company is not part of a wider group that is ineligible. Now, the current rules on group ineligibility say that a group is ineligible if it contains either a company with shares traded on a regulated market anywhere in the world, or if it contains a body corporate other than a company with shares traded on an EEA regulated market. Now, when the Brexit regulations come in at the end of this year, those ineligibility criteria will change so that now a group is ineligible if it contains a company or a body corporate with shares traded on a UK regulated market. Next slide, please. So this will therefore narrow the scope of ineligibility. And so once the Brexit regulations come in at the end of this year, it may be that more groups qualify as small, and so that they don't have to rely on the intermediate parent exemptions to get exemption from the parent group accounts. Next slide, please. So that takes us on to those intermediate parent company exemptions that may be available to a parent company that fails to qualify as small. Under Section 400 of the Companies Act, if you're an intermediate parent company, you could be exempt from preparing group accounts if you're included in the accounts of a larger group based in the EEA. Or under Section 401, if you're included in the accounts of a larger group based anywhere else in the world. Now, to be able to take those exemptions, there are certain requirements that need to be met, certain hoops that need to be jumped through before you can do so. And one of those is that you need to file the consolidated accounts of that larger group at Companies House, and those accounts need to be in English. Next slide, please. When the Brexit regulations come in, they'll have the effect of changing EEA stroke non-EEA to become UK stroke non-UK. Now what that means is that Section 400 will no longer be available to companies with an immediate parent company outside the UK. So if at the moment I'm a parent company myself, but I've got a parent further up the chain, say in Germany, currently I can claim exemption to prepare group accounts on the basis of Section 400. However, once the Brexit regulations come in, I won't be able to use Section 400. Not a problem, you might say, I'll just fall back on Section 401, which I can do, however, provided the consolidated accounts of that non-UK parent are drawn up in accordance with the Companies Act 2006 and also UK adopted international accounting standards. Now, at the moment, UK adopted international accounting standards are the same as EU adopted international accounting standards, so there's no real change there. But we see this could be an issue in future if the UK and the EU take different approaches to future standards and amendments, and our accounting framework ceases to be equivalent. So we could potentially have the situation where, as a result of Brexit, we have more parent companies that are able to take the small group exemption, but we have less that are able to take the intermediate parent exemptions. So just something to be aware of if you are an intermediate parent or a parent company and you currently claim exemption from preparing group accounts. Okay, next slide, please. Just one point on audit exemption and Brexit. At the moment, if you are a subsidiary undertaking and you're not small, the only way you can get audit exemption is if you have a parent company within the EU that's willing to provide a parent guarantee. With Brexit coming in, that'll only be available to subsidiaries of UK parents. So again, something to bear in mind if that affects you. Next slide, please. So those are some of the issues we should think about with Brexit. Finally, we'll just finish this session with a look at what has changed recently in financial reporting and where things might be headed. Next slide, please. For most of us here today, financial reporting requirements are dictated by FRS 102. So broadly, unless you're a micro entity applying FRS 105 or a listed company applying international accounting standards, what you need to do will change as the FRC makes changes to FRS 102. The FRC have pledged to carry out triennial reviews of FRS 102 so that changes are only made once every 3 years. That's, of course, unless circumstances dictate that changes should be made that can't wait, such as the amendment for COVID-19 related rent concessions that Craig mentioned a short while ago. Now, the last triennial review was carried out in December 2017, resulting in the publication of a revised FRS 102 in March 2018. And it wasn't really until December 2019 year ends that we first felt the effect of the changes. Next slide, please. If any of the changes coming out of the 2017 review affected your business, I suspect you will have already become familiar with them as you or we prepared your last set of year-end accounts. However, if your company has a September, October or November year-end, you may only just be applying them in practice. Just as a quick recap, the changes made were largely in areas which many preparers of accounts were uncomfortable with from the outset of FRS 102, but had to persevere with until the 2017 review came along. Some changes were mandatory and some changes were optional. Now, the most significant mandatory change was the requirement that all investment properties should be measured at fair value each year, although there is an optional exemption for properties rented out to group companies, which I'll come to shortly. So this meant that the previous opt-out, on the grounds that the fair value couldn't be reliably obtained without undue cost or effort, was removed. Now, this was a bit of a blow for OMBs who had previously been able to avoid the cost of an annual property valuation and justify not doing so on the grounds that they didn't really benefit from the information. However, it's worth remembering that valuations don't have to be carried out externally. Directors are able to perform the valuations. However, if the annual valuation is performed by a director, they need to make sure that they follow the approach set out in Section 2 of FRS 102. If they're unable to follow that approach or are unable to demonstrate that they followed that approach, then it's probable that an external professional valuation will be required, particularly if auditors are involved. In terms of recognition of tax relief on gift aid payments, a more welcome amendment to FRS 102 made it mandatory that where the subsidiary of a charity distributes its pre-tax profits to the charity as a gift aid payment within 9 months of the year end, then the tax relief of that gift aid payment is recognised at the balance sheet date. Previously, the tax relief couldn't be recognised in advance of the payment, so there was a change there. Next slide, please. Other mandatory changes were made to clarify the definition of a basic financial instrument to make it easier to determine if a third-party loan qualified as basic and was therefore subject to simpler accounting rules. And changes were also made to remove some disclosures that weren't really that useful, if we're honest, such as stock recognising as expense, and to reinstate the reconciliation of changes in net debt, which always used to be part of the cash flow statement, but was removed when FRS 102 came in. Next slide, please. There were also changes that were optional, including the option to treat property that was rented to other group companies as property, plant and equipment and carry it at depreciated cost, thereby avoiding the need for an annual valuation with changes through the P&L account, which, as we've seen, would have been the case if treated as an investment property. Changes were also made to the requirement to separate intangible assets from goodwill in business combinations, meaning that going forward, fewer intangible assets will have to be separated out from goodwill when one company acquires another. And another very welcome change was to allow loans to small companies from director shareholders to be carried on the balance sheet at face value rather than present value, thereby simplifying the accounting treatment. Next slide, please. So that was the triennial review of December 2017, and we're now at the 3rd anniversary of that review. So we therefore expect something from the FRC on the next review in the near future, although there has been very little on it so far. I think we can probably anticipate a revision to FRS 102 sometime in 2021 for application in 2022. It also remains to be seen what the topics of change may be. FRS 102 came in 2015, And so 2017 was the first opportunity for changes to be made to it. And as we've just seen, there were a fair few changes. Whether the review this time around will result in as many changes, we'll just have to wait and see. Some commentators think that the radical changes made to accounting for leases in International Accounting Standard IFRS 16 may come through into FRS 102 with the next triennial review. FRS 102 was, after all, based on International Accounting Standards. Now, were this to happen, it would mean that we'd see operating leases come onto the balance sheet, which would be a very significant change, particularly for companies which rent their property on long-term leases. It would also involve a lot of work for accounts departments to catalogue all of their leases and analyse the terms of the leases so that the amounts to be recognised in the accounts can be calculated. It would mean considerable planning and preparation time to get that transition right. So that could be a possibility. However, others think that it may still be a bit premature for this to be implemented in the next cycle of changes. We'll just have to wait and see on that. Any changes that do come in, I think we can reasonably expect that it won't be probably until December 22 year ends when they first apply. So a little way off yet, and that's based on the timescale of the previous review. So I therefore suggest that at this point, for the moment, you keep an eye on our website and the usual technical resources over the next few months to stay informed on this. Next slide, please. So that concludes pretty much what we wanted to cover in this seminar. I hope you found the information useful, either as new issues for you to take away and think about, or as a reminder of matters that you may already have had an awareness of. So thanks for listening. I think at this point, we can probably take any questions you may have raised in the chat.
Yeah, I'm just looking at the chat, Paul, and I can't see any questions in there at the moment. So if anyone has any questions, please feel free either to put them in the chat or unmute yourself and ask a question. So yeah, question, will a copy of the slides be available? Yes, we can send the slides out to people who've attended. That's not a problem. There's another one here. Will the Brexit have a change in the reporting? Paul, do you want to pick that up?
I guess depends what you mean by change in the reporting. I think we've sort of been through there, or tried to go through there in the slides, where we think the financial reporting will change with disclosures, etc. In terms of, okay, so it's the layout. Not aware that there'll be any change to the structure of the accounts. You know, the primary statements, etc. So we don't foresee anything there. No.
I mean, I think that the layout set out by the Companies Act and FRS 102. Sorry, you just said that means new IAS. I think in terms of international financial reporting standards, I don't think, again, that there's any change that that is anticipated. As Paul said, as we go through, UK and EU adopted IFRS might change, but the IFRSs will still be determined by the International Accounting Standards Board. It'll just be up to the new FRS, not IAS. Okay, so I don't think FRS 102 is going to change as a result of Brexit. I think obviously we'll wait and see what comes out in the new triennial review, but we're not expecting a change to what the primary statements look like as a result of Brexit for FRS 102 going forward.
I mean, with Brexit, the government have created a new sort of accounting body within the UK to sort of oversee the setting of accounting standards. So they'll probably be keeping an eye on what changes with international standards and whether they come into UK GAAP or not. So again, it'd just be something to see. I imagine the plan would try and keep some kind of equivalence, just so that we can, you know, proceed without too many blips. But we'll have to wait and see, really.
I think that probably comes back to the point that Paul made about the equivalence to be able to take Section 401 exemption from consolidation. I think the UK will want to keep the red tape for UK businesses as low as possible. So we'll try and keep us equivalent so that people can use Section 401 where they have EU parent companies. Anyone else got any questions? If not, then I think we'll bring the seminar to a close. Thank you all for attending. As I said earlier, if you do think of any more questions, please feel free to email either Paul or myself or your normal Horson's contact, who will no doubt send them on to us, and we will answer them as the best that we can. So thank you all for attending. Have a good Christmas and a Happy New Year, and hopefully see you soon.